Welcome back to the Loan Modification and Short Sale Outreach Workshop. I'm Ken Krotz. I'm a real estate broker in the Great Northwest, and I'm a certified short sale specialist. Loan modifications play an important role for many people in achieving or re-achieving financial stability. Let's take a look. The first thing to consider with loan modifications is they're designed for the top 5 to 10% of homeowners who are on the verge of losing their homes. Applicants must qualify from an income standpoint. Just like your original loan application, for a loan modification, the lender will still require that you have enough income on a monthly basis to qualify to make the payments. Now, the difference with a loan modification is they're not going to take into consideration your credit score or your credit report to the extent that they do with a new loan origination. The Obama plan provides financial incentives for lenders to modify loans. The Obama plan is going to be limited to Fannie Mae and Freddie Mac lenders and other lenders who have chosen voluntarily to participate. It's important to understand that loan modification is voluntary by the lenders, and they can choose to either grant or not to grant a loan modifications. And it's not necessarily just going to be based upon your qualifications and your income. Whether or not they're a servicer, a bank, a mortgage insurance company, whether or not they're Fannie Mae or Freddie Mac backed, or the attitude of the particular investor that holds the paper is going to have a lot to do with whether or not a particular lender is going to grant a loan modification on a particular loan. It also comes right down to the personalities of the people that you end up dealing with at the bank. One of the most popular ways to do a loan modification is through a loan modification company. In Washington State, loan modification companies have to be registered with the Department of Financial Institutions. I have links on my websites to the Department of Financial Institutions, or DFI. One includes a license link to see if your loan modification is actually licensed in the state of Washington. And the DFI also has several bulletins on how to avoid being taken advantage of in a loan modification scam. Generally, they encourage you not to pay money up front. On my website, I will also have a link to the DFI, or Department of Financial Institutions, fee agreement that you can use when dealing with a loan modification. If you present this to them and they refuse to do business with you, then that's probably a pretty good sign that the loan modification company is not legitimate. Keep in mind that many of the people that will be contacting you once it becomes public knowledge that you're having a hardship will be from out of state. I've met loan modification companies from California, Texas, Colorado, and Florida. It seems the markets that are hardest hit are the ones where the loan modification companies are operating most aggressively. The Department of Financial Institutions is also going to tell you that loan modification is something that you can do yourself. And I've developed a number of tools to help you do just that. To do a loan modification yourself, just using the tools that we're going to provide you for free. So rather than paying somebody $2,500 or $3,000 up front to do what you can do yourself, you can go to my website, download tips on how to talk to your lender, tips from top negotiators, a homeowner loan modification kit, and a complete list of HUD-approved free counselors that you can talk to at no cost to yourself. So before falling for a loan modification company pitch, look into what it's going to take to get a loan modification and consider doing it yourself. The next question is, when is a loan modification good for you? Well, I would contend that a loan modification is only going to be good for you if it's going to reduce your monthly payment down to 31% of your gross income or less. That's a standard set by the Obama plan and a common lender qualification standard. There's good reason for it. If your gross monthly income and your payment doesn't exceed 31% of your gross monthly income, there's a good chance you're going to have money left over for groceries, for car payments, for consumer debts, for taxes and insurance, and the like, and you'll be able to make your house payments on an ongoing basis. Now, when is a loan modification not good for you? Well, a loan modification is not good for you if it exceeds 31% of your gross monthly income. Remember here, in this workshop, our goal is to help you achieve the financial stability that you once had, to get the monkey off your back that's in the form of a mortgage or financial hardship, and get you on the road to either financial stability or setting yourself up to take advantage of the market as it bottoms out in 1.5 to 2 years. I've seen many loan modifications come back to the homeowners suggesting that they pay 120 to 150% of what their mortgage payment was prior to their starting the loan modification. Well, what's happening in that case is you're talking to the debt collection department, and they're simply trying to extract as much money as possible before taking the house back. A recent statistic shows that over 80% of loan modification recipients actually end up redefaulting on their loans. The reason is people accept any loan modification that the company presents to them without having a clear picture of what they need in a loan modification to make it work out. Remember, take your gross monthly income times 31%. If the bank comes back with a loan modification that's greater than that, simply let them know that that's not going to work, and you don't want to get on a treadmill that's going to lead you right back to a default and foreclosure. And the real sad part is you can get a loan modification, suffer through 8 more months of hardship, and lose your property in your house anyways, after probably losing much of your savings and or retirement. Our goal is to help you preserve your assets and get you back to financial stability. Now, if you have equity in your property in a short-term hardship, as we covered in an earlier segment, loan modification is probably one of the best options for you in your situation. Because you can lower your monthly payments and you have a short-term hardship, recovery is a high probability. And if you can demonstrate that the reduction is going to get you back onto the road to financial recovery, that's also a great time. Drawbacks to loan modifications. They can perpetuate the hardship rather than solve it. Only accept modifications that resolve your financial hardship. If they don't address the issue, well, one of the biggest drawbacks is they don't address the issue of negative equity. If you owe more than your house is worth, a loan modification is not going to address the fact that you'll continue to make payments on a non-performing asset, your home, for months or years to come. In that case, if you have negative equity, I'd encourage you to take a look at my short sale loan modification calculator, put in your particular numbers, and take a look at what the forward view is going to be for your financial outlook going forward. This is a great tool to help you make a decision as to how to proceed and what's going to be best for yourself and your family. The other thing about loan modifications is they're not easy to get. We're going to provide you the tools you need, advice and support, but it's going to take a lot of determination and intestinal fortitude on your part and stick-to-itiveness on your part to get the loan modification. Understanding how the banks work and what they're after is part of the first report that I have for you, how to talk to your lender. This is going to give you insight on what the bank's after. They are not necessarily going to offer you what's best for you right out the door. They're not that concerned about your welfare. They're concerned about mitigating the loss to their company and for their shareholders. So as long as you're really clear about how loan modification is going to help you, what the numbers are that you can accept, you will have a guide to stick to your guns when the company comes back with unacceptable proposals, and to continue to negotiate and to push your lender to come back with a loan modification that's going to help you and your family stay in your house for the long term. I appreciate your time and your interest in this short segment. My next segment is going to be how to the particulars of going through a loan modification, what it takes, some strategies to use. I'll introduce to you the free reports that I've been referring to in the earlier 2 segments and this one, and give you the tools you need to get started with the loan modification. My name is Ken Krotz. I'm a real estate broker and certified short sale specialist in the Seattle-King County area of Washington, and I appreciate your time. Have a great night.